Welcome back to the deep dive. So, if you hold any digital assets, you know this feeling. It's the single most annoying point of friction, right?
Absolutely.
You got this decentralized money, but you still have to buy, I don't know, a very centralized coffee. Today, we are taking your sources and we're really tackling that ultimate dilemma for crypto holders.
Hmm.
How do you spend your crypto quickly, legally, globally?
Yeah.
And, without sacrificing the whole philosophy that got you into crypto in the first place.
It is the constant roadblock. One minute you're on a DEX feeling totally in control, and the next you're just trying to figure out how to bridge that gap to buy something in the real world.
Right.
And our sources today, we've got a great strategic comparison doc and some really detailed B2B infrastructure notes. They lay out two fundamentally different ways to do this.
That's right. So on one side, we have let's call it the established traditional crypto card.
Yeah.
The one that, got popular years ago.
The OGs.
Exactly. And on the other side, we're looking at the truly decentralized alternatives. And we're using a system called PintoPay as our main case study for that new generation.
Yeah, and our mission today is really to get beyond just a list of features. We want to give you a framework for making a decision. The core question for you, listening, is where you personally draw the line between convenience and data sovereignty.
The trade-offs.
The trade-offs. We've got to look at both options, understand the real costs, and just set some realistic expectations for what it means to use crypto day to day.
Okay, so let's start with the path most people took first. The traditional crypto card. I mean, when these first launched, they felt completely revolutionary. You'd link your exchange wallet, you get a card, probably co-branded with Visa or MasterCard, and suddenly, boom, you could pay for lunch with Bitcoin.
It seemed like the problem was solved.
It did.
And look, it was an ingenious bridge, a necessary one, but the cost of that bridge was centralization. I mean, to even function in the real world, these cards had to rely completely on centralized exchanges.
And those exchanges had to act basically like neobanks.
Exactly. They had to take possession of your funds, they had to manage the instant conversion, and then process everything through the traditional payment rails.
So the magic bullet wasn't actually magic. It was just a really, really fast, automated fiat conversion engine.
That's the mechanism.
You swipe the card, the exchange instantly sells a bit of your crypto for dollars or euros, and then loads that fiat onto the card to finish the purchase.
That's it. And that is why these cards, which were, incredibly convenient for using them worldwide because they use those huge existing networks.
Of course.
They came with a non-negotiable requirement. Know your customer. KYC.
Right. The exchange had to comply with regulations, which meant you're handing over your ID, your personal data, and they're keeping control over your funds and your transaction history.
And that's the philosophical sticking point, isn't it?
It is. If the whole promise of crypto was escaping that traditional surveillance model, achieving real autonomy, then how do these traditional cards really fit that?
They don't. They pull you right back under that umbrella of centralized data control.
Yeah.
They absolutely offer convenience, but it's at the expense of the philosophy. And for a lot of users, especially if you're deep into DeFi, that trade-off is it's not acceptable.
Okay, so if centralized control and mandatory KYC are the big drawbacks of that first generation, then the obvious next question is, what does a system built specifically to avoid that look like?
And that leads us right to the decentralized alternative, with PintoPay as the example.
What's so interesting here is that this new generation isn't trying to, replace Visa or MasterCard.
No, not at all. It's designed to minimize the centralized entity that sits on top of the network. The sources describe PintoPay as a next-gen service bridging crypto and traditional finance, but doing it with a secure neobank infrastructure that's focused on autonomy.
So from my perspective, as the user, it looks and feels pretty much the same.
Incredibly familiar.
That lets you spend crypto instantly through Apple Pay, Google Pay, a physical card. But the big difference is all under the hood in the architecture.
Precisely. The key innovation, and this is why we can call it a decentralized alternative, is its ability to offer the option to bypass those strict KYC requirements that the traditional card providers mandate.
Okay, but how does that actually work from a compliance standpoint?
Yeah.
I mean, if they're using the same Visa and MasterCard rails, don't they have to follow all the same rules?
That is the nuance our sources really stress. It's not about breaking rules. Services like PintoPay often operate with a secure, regulated infrastructure that lets them issue cards that meet certain spending thresholds without needing full identity verification.
So they're aligning with certain regulatory frameworks for like lower limit accounts.
Exactly. It means they can maintain compliance while giving the user the maximum privacy options possible, depending on how much they're using it.
So the card is active instantly, virtual or physical, you top it up with crypto or fiat. But the crucial part is that the whole system for getting onto those global payment rails is built to reduce or just remove the power and the data hoarding that you see with a typical centralized exchange.
It's all about preserving privacy and autonomy while still giving you that global convenience. It's a necessary evolution, really. The market wanted the convenience of the old system, but the user base was demanding the privacy of DeFi. This is the attempt to deliver both.
All right, let's step back from the architecture and get practical. This is where we get into the head-to-head comparison. How does all this affect your wallet, your data, your rewards? Let's start with that big dividing line again. Privacy and KYC.
And this is where the choice is just so stark. I mean, traditional crypto cards, they demand mandatory KYC. You're handing over your documents, you're giving up centralized data control, period.
Whereas PintoPay, by offering the option to bypass KYC, it aligns perfectly with users who put a premium on that data sovereignty, on the core DeFi ethos.
Yeah, and if you're a user in a country with, let's say, high financial surveillance, this isn't just a philosophical choice, it's a security necessity.
Absolutely.
Yeah.
It elevates the whole conversation from just convenience to security and autonomy.
Okay, let's talk hard numbers, costs. What are you paying for convenience and what are you paying for privacy?
So based on the data points and the sources, the fee structures are a bit different. For PintoPay, the one-time card fees are cited at 25 USDT.
25 bucks.
Right. Though sometimes they discount it down to 12 USDT.
And for our listeners who might not be constantly using stablecoins, can you remind us what USDT signifies here?
Good question. USDT is Tether. Essentially, it's a digital token that's pegged one-to-one to the US dollar.
So it's just a way to keep the price stable.
Exactly. It makes sure the cost of the card itself doesn't swing wildly with market volatility. It's a very, crypto-native way to handle pricing.
Got it. And what about the cost of actually moving the money, the top-up fees?
Right, the operational fees. Depending on the card type or the level of integration, those range from 1.5% to 2%. That's the actual transaction cost you pay for that instant liquidity. Okay, that brings us to rewards. Traditional crypto cards got famous by playing the classic banking playbook. Cashback.
Cashback.
Spend money, get a percentage back, usually in some native utility token. It's simple, easy to understand.
Instantly appealing. But PintoPay offers a different philosophical take on incentives. Instead of just traditional cashback, their whole approach is about integrating with DeFi.
Decentralized finance.
Right. It suggests a utility or a financial benefit that's native to the decentralized space. So the rewards are less about an immediate kickback and more about, say, enabling participation in decentralized lending or yield generation.
So if I just want 2% back on my coffee, the traditional card wins that round.
For that specific need, yes.
But if I want a product that actually maximizes the utility of my digital assets inside the DeFi ecosystem, the decentralized path is probably more appealing.
That is the critical distinction. And then finally, on convenience and acceptance, they're both aiming for the same thing: global ubiquity. Traditional cards get it through their direct partnerships. PintoPay gets it by leveraging that exact same network through its own infrastructure.
Now, to really understand why this new path is so important strategically, I think we need to shift focus a bit and look at the infrastructure side, the B2B context.
Yes.
Because this is what's changing the whole ecosystem.
This is where it moves beyond just a simple consumer product. It highlights that services like PintoPay are really financial logistics powerhouses.
Yeah.
They provide the deep plumbing,
The plumbing.
handling cross-border transfers, secure internal money movement, and then giving partners like existing crypto wallets or exchanges the actual tools to issue their own branded cards.
But this is huge for developers and entrepreneurs. A company doesn't have to spend years and millions of dollars building a compliant global card system from scratch.
No, they just plug into this ready-made solution.
And our sources detail two main ways they can do that, two integration formats.
Right, and each one reflects a trade-off between cost and control.
Let's look at the first one, the API solution. This seems like the lower barrier to entry for projects that already have some of their own infrastructure.
Especially their own crypto wallets, yeah. The cost for the API solution is $9,500.
Oh.
That gets them access to the API library and technical support. But the key insight here is that it's a DIY package. There's no built-in client interface, no custom branding. It's for companies that want to embed this functionality deep inside their existing platform. It buys them the operational backbone.
Then we have the jump to the full-service package, the white label solution. This is for partners who want a true ready-made product they can launch immediately.
This one's a lot more expensive. It comes in at $30,500. But the insight here is that this price actually democratizes really sophisticated payment infrastructure. For that investment, the partner gets a complete, ready-to-launch system. We're talking custom branding, a full admin interface, crucial support services, even a Telegram mini app for their clients.
And why would a company pay that much? I mean, the revenue potential must be enormous. This spending feature isn't just a cool add-on.
Oh, it's a significant revenue generator. Absolutely. The forecast in the documents is really compelling. Partners can expect a very substantial new revenue stream.
How much are we talking?
The estimate is somewhere between $10,000 and $20,000 in monthly income. And that's based on the commission they collect from a pretty moderate transaction volume.
So they get a 1 to 2% cut.
Exactly. It just shows the scale of the incentive to integrate these tools. They turn a crypto wallet from just a holding account into a liquid, daily use financial tool.
So after all that, what's the final takeaway? We started this deep dive asking which path is better, the centralized card or the decentralized alternative like PintoPay.
And our synthesis confirms what we almost always find in decentralized finance. There's no single best option.
It depends.
It depends entirely on your personal priority matrix. I mean, do you prioritize absolute convenience and you're comfortable exchanging privacy for an established banking relationship?
Then the traditional crypto card wins.
It does. But if your priority is privacy, autonomy, and staying true to that core decentralized philosophy, if you want to use these systems with minimized KYC, then the PintoPay approach is strategically aligned with what you need.
You get to choose your level of centralization.
It forces you, the user, to be intentional about what you value most.
So here's the critical question moving forward, and this is our final thought for you to chew on. If services like PintoPay are providing this scalable, ready-made infrastructure, these API and white label solutions that ultimately leverage the same established global networks like Visa and MasterCard, what does that really say about the future of crypto spending?
Does the true innovation lie in minimizing or even eliminating the centralized entity that sits between your crypto wallet and the existing global payment rails, rather than trying to replace the entire card network itself? If the goal is mass adoption without mass surveillance, then maybe the most pragmatic path forward is to just use the rails the world already accepts, but with new autonomous on-ramps. That might be the real bridge to the future.